Every war follows the same pattern. You've seen it before, even if you didn't realize it. The headlines explode overnight. Oil prices spike, markets panic. Politicians step in front of cameras and deliver carefully crafted speeches. Experts flood television panels, repeating the same phrases, the same warnings, the same predictions. Then, almost like clockwork, the panic fades, prices settle, charts return to their previous trends. Life moves on. It happens every time. The Gulf War, Iraq, Libya, Syria, Yemen. Different places, different years, same script. Traders even gave it a name. Buy the rumor, sell the news. Because once the missiles are launched, once the shock hits, the market adjusts, absorbs it, and moves forward. That's how it has always worked. Except this time, something broke. And what broke the pattern isn't the war itself, it's a number. A quiet number sitting in a public report that updates every single business day. No headlines, no breaking news alerts, no urgent commentary from financial anchors. Just a simple figure that almost no one is paying attention to. 79 million ounces, that's it. That's the total amount of registered silver sitting inside COMEX vaults as of March 12th, 2026. Not theoretical supply, not estimates, not paper contracts. Real, physical silver that can actually be delivered when someone demands it. And that number is shrinking, fast, faster than anything we've seen in years. To understand why this matters, you have to understand what registered really means. It's not just silver sitting in storage. It's the only category of silver that is immediately available for delivery against futures contracts. When a buyer steps forward and says, "I want the metal," this is where it comes from. Not promises, not claims, actual metal. And right now, that pool is being drained at a pace that doesn't match anything in the historical playbook. Because while the world is focused on war, something deeper is happening beneath the surface. The chain reaction started on February 28th, 2026. The United States and Israel launched coordinated strikes against Iran. Within days, the situation escalated beyond what most analysts had modeled. Leadership changed, decisions were made quickly, aggressively, and with long-term consequences in mind. Then came the move that changed everything. The Strait of Hormuz was effectively closed, not partially restricted, not symbolically threatened, closed. If you've never looked at a map, it might not sound like much. But that narrow stretch of water carries around 20% of the world's oil supply. Roughly 20 million barrels per day move through that corridor. It is one of the most critical choke points in the global economy. And suddenly, it was no longer accessible. Exports from major producers were disrupted. Supply chains fractured overnight. Insurance costs for shipping skyrocketed. Even routes that remained technically open became economically unviable. The result was immediate. Oil surged. Brent crude jumped from around $70 to $120 within days. It later stabilized, but not in a comforting way. Instead of falling back to previous levels, it formed a new range, hovering between $90 and $110. That's not a correction. That's a new reality. Because when millions of barrels per day are removed from accessible supply, the system doesn't just bounce back. It recalibrates. It adjusts to a new baseline. And that new baseline comes with consequences. Energy costs rise. Transportation becomes more expensive. Manufacturing slows. Food prices climb. Every layer of the economy feels the pressure. Inflation, which central banks had spent years trying to control, starts to creep back up again. At the same time, growth begins to weaken. That combination is dangerous because it puts policymakers in a position where every decision has a downside. If they raise interest rates to fight inflation, they risk slowing the economy even further. If they cut rates to support growth, they risk fueling even more inflation. There's a word for this situation: stagflation. And historically, stagflation has been one of the most powerful catalysts for precious metals. But this time, something unusual is happening. The dollar is strengthening. Under normal conditions, a strong dollar would suppress gold and silver prices. It makes them more expensive for international buyers. It reduces demand. But right now, both are rising together. That's not supposed to happen. Gold has surged to levels that would have seemed unthinkable just a year ago. It's not just climbing, it's accelerating. And it's doing so even as the dollar gains strength. That tells you something important. This isn't a normal market. This is fear, not short-term panic, but structural concern. A shift in how capital is being positioned globally. Investors, institutions, even central banks are moving into assets that they believe will hold value under extreme conditions. And then there's silver. Silver isn't just following gold. It's doing something far more explosive. A year ago, it was trading around $33. Today, even after volatility and pullbacks, it has more than doubled. It spiked above $120 earlier this year before pulling back into the $80 range. That kind of movement doesn't happen without a reason. Actually, it happens when multiple forces collide at the same time. On one side, you have macro pressure, inflation, geopolitical risk, monetary uncertainty. On the other side, you have something more fundamental, supply. And that's where things get interesting, because silver isn't just a monetary metal, it's an industrial one. Around 65% of its demand comes from real-world applications. Electronics, solar panels, manufacturing processes that are essential to modern infrastructure. Demand isn't theoretical, it's physical, and supply has been struggling to keep up for years. This isn't a new problem. The market has been running a deficit for 6 consecutive years. More silver is being consumed than produced. The gap has been filled by inventories, stockpiles, and secondary sources, but those buffers are shrinking. Now add in what's happening inside COMEX vaults. In just 1 week earlier this year, over 30 million ounces were withdrawn from registered inventories, not reclassified, not moved between categories, removed completely, delivered, taken off the board. When you compare total physical silver in the system to the number of paper claims against it, the imbalance becomes clear. There are multiple claims for every single ounce of real metal. That works fine as long as most participants settle in cash or roll their contracts forward. But if more and more participants start demanding delivery, the system gets stressed, and that stress is already visible. Prices in certain markets are higher than in others. Premiums are rising. Lease rates have spiked dramatically, indicating that borrowing physical silver has become significantly more expensive. These are not normal conditions. They are signals that the physical market and the paper market are no longer aligned. And when those two diverge, history shows that eventually one has to adjust. It's usually the paper market. Meanwhile, global dynamics are shifting in ways that add even more pressure. Some countries are no longer treating silver as just another commodity. Policies are changing. Export restrictions are tightening. Strategic reserves are being prioritized. When governments start viewing a material as strategically important, it changes how it flows through the global system. It doesn't just respond to price anymore. It responds to policy. And policy doesn't reverse easily. At the same time, industrial demand continues to evolve. Manufacturers are trying to adapt by reducing the amount of silver used in their products. It's a process known as thrifting. But there are limits to how far that can go. You can only reduce so much before performance is affected. And those limits are approaching. All of this is happening while the broader financial system is dealing with rising debt, higher borrowing costs, and increasing uncertainty about future growth. Markets are reacting. Volatility has increased. Equity indices have experienced sharp drops. Investors are becoming more cautious. Liquidity is tightening in certain areas. And yet, beneath all of that noise, the silver story continues to build. Quietly, relentlessly. Not everyone sees it. In fact, most people don't, because it's not being discussed on mainstream platforms with the urgency it deserves. It's buried in reports, hidden in data, overlooked in favor of more immediate headlines. But the information is there, public, accessible, waiting for those who know where to look. And that creates a unique situation, because when a market begins to shift before widespread awareness, the early phase is often the most significant. That doesn't mean it moves in a straight line. There will be pullbacks, corrections, moments where the narrative seems to weaken. There are real risks. If economic conditions deteriorate further, industrial demand could soften. If monetary policy remains tight, it could create temporary pressure on non-yielding assets. If geopolitical tensions ease, some of the fear premium could fade. Those are valid considerations. But they exist alongside a set of conditions that are increasingly difficult to ignore: a shrinking pool of deliverable supply, rising physical demand, structural changes in global policy, and a macro environment that historically favors tangible assets. At some point, those forces converge. And when they do, the adjustment is rarely subtle. It tends to be sharp, decisive, and difficult to reverse. Right now, the market is telling two different stories. One is based on price charts and short-term movements. It suggests that the major move has already happened, that what we're seeing now is consolidation, maybe even the beginning of a slowdown. The other story is based on physical flows, inventory levels, and real-world demand. It suggests that the underlying pressure is still building, that what we've seen so far may only be the beginning. Both cannot be true indefinitely. Eventually, they will reconcile. And when they do, the direction of that reconciliation will define the next phase. Because markets don't stay in imbalance forever. They correct, they adjust, they find equilibrium. But the path to that equilibrium can be unpredictable, and sometimes it moves faster than anyone expects. That's where we are now. Not at the end of a cycle, but somewhere in the middle of a transition, a point where the signals are visible but not yet fully understood by the majority, a point where the data tells a story that hasn't fully reached the headlines, and a point where paying attention matters more than ever, because in environments like this, the difference between reacting and anticipating can be everything.